So if you've never done a pitch book before, I have a couple of examples here on YouTube. You're essentially building a PowerPoint. We're doing the sell side, so it's a little bit fancy. So what do you want to do when you do the pitch book? So let's walk through this. This document's out there on Canvas. The first thing you're going to do is give your thesis, or not even thesis, just your main, are you recommend a buy or not? And you want to say in a few words why you're saying that. So I believe this stock will outperform its industry and the market given its advantages and whatever. So make that obvious up front. If you have 4 reasons, 3 reasons, you want to work them through that as you go through the presentation. The next part is not in any order. It's just the kind of things you're going to do. You're going to be interspersing different things here. You do start off with who is this company, give some background. Some companies are easier than others because everybody knows McDonald's or Walmart. So you don't have to spend as much time. But who is the company? What's their culture? What's their products? What's their position in the product life cycle? You can do segment pie charts here. Revenue growth by year looks really good. It really looks good, the comparison of these things to competitors as well, because it gives them a sense of, wow, this company's growing 15% where their competitors are growing 5% or something along those lines. So establish up front who they are, who are their competitors, how are they unique. You might do some history of the firm. We saw a few of y'all last semester did a good job of putting the stock price history and putting arrows from certain things that happened during that history. That works really, really well. That's pretty popular. It's usually good to have the stock price history somewhere in your presentation. Definitely you talk about management. Is there any founder still involved? There's any really key management person who's famous? Is there a CEO like we saw with Berkshire Hathaway retiring? And then if you can find some strong quotes from management, that really, really helps. If not, find some strong quotes from, the buy side or the sell side, well, the sell side. You might do something on, some of y'all talk about this. Most of your firms are going to be owned by Vanguard, BlackRock, State Street. But if there is any type of activist investor going on, talk about it. Obviously, Netflix and Oracle and, these firms in the middle of a major battle, you'd want to talk about that. And then spend some time on what really makes this firm unique. That's probably the most important part. Economic mode, sustainable competitive advantage. Those are 2 terms you can put into ChatGPT or some other source and see what they say, summarize it for you. So what's changing most about the firm? That's why I think is management's most important part about the firm is management changes things. They're doing something different. Focus in on CapEx, on M&A. What is management? Where are they spending the money? Talk about the competitors. SWOT analysis is something else you can do in ChatGPT. Talk some about the risk. There's 2 ways you can do risk. Is the risk the company faces, but you can also talk, but I should probably put this in here, but the risk to your thesis. So that's pretty a good way to talk about it. Where could you be wrong? We'll talk tonight about company fundamentals. Last semester, I thought some of your presentations were really lacking in some charts on fundamentals, whether it's margins or return on capital or something that shows what's happening over time. And then also versus competitors. So I'll show you the chart today. A lot of these charts are already built, so you have it. We'll talk about the valuation model tonight, and then your final opinion. So that's what you're doing. If you watch some of these videos, I showed you this one last semester. They did a great job of setting it up front. All right. So if it's your first time to do this, I would recommend watching some of these. Your presentation is going to be about 10 minutes, so you're not making a massive presentation, but just a few minutes. 10 minutes is actually a pretty long time. I won't say it's the strongest presentation last semester, but it was really, really good, and he asked for it. So I might give you Colby's Amazon presentation from last semester. I thought that was really, really strong, and I can get it on YouTube and get his permission to send it to you. So you get one from the class. I got to remember to keep these presentations because the Zoom recordings all disappear over time. All right, questions what you do. You got 1 month to get this for a stock, right? And I'll start setting up times for y'all to start presenting. You got to present probably before. I mean, our deadline is March 1st. I don't know if that means if I do trades on March 1st, that counts. I don't know if it says by March 1st or by the end of March 1st. But your presentation probably needs to happen before noon on February 28th. Also remember, and this is real critical, you need to watch the presentations from your team. I realize energy and utilities, you got to split those into 2 groups. You should have 4 people or so on your team. You need to watch all of their presentations. So that's an additional hour of your time that you're going to watch. You don't have to do it live. We'll do it on Zoom, but you need to watch it because you're going to have to sometime before noon on February 28th, you're going to have to vote as a team which of those stock pitches you want to actually purchase. We have 26 stocks right now. We've purchased 28. We had to sell 2 of them. I have one more. We purchased 29 and I had to sell. No, wait, we purchased 28, had to sell 3. Had to sell 1 today. So if they fall below their sector by more than 15%, I've got to sell it. So we've had 3 stocks that have done that. So we've got essentially 25 stocks and we need to have 30 stocks. So it's not like I got to get a stock from every one of you, but I got to buy at least 5 stocks. And that's assuming I don't sell any between now and then. I also have to get the ETFs down below 60%. That one's going to be even more difficult. So I've got to get more ideas from you. So the clock is running. A lot of chat GPT. So if I were you, I would be reading the annual report. I would be putting economic moats, sustainable competitive advantage, those kind of things in the chat GPT. I'd be going on YouTube and looking for the CEO and asking what they're saying about the firm. Those type of things are what's going to help you get to what this firm is doing. Let's talk financial analysis. So this doesn't look good. Let me refresh. Where's the refresh? See it? Why don't I see it? Top left. Oh, there it is. All right. So refresh workbook. So this thing is tied. It's tied to Capital IQ. The Bloomberg stuff here is pasted as values, so you don't need the Bloomberg to actually work, but you need Capital IQ to work. So you probably can't do it from home. Let's let that refresh. So this is one I built for banks. There's another one that is for all companies. That's banks again. Where's my other one? Yeah, it won't let me switch because I'm in Capital IQ. There is a YouTube that walks you through this, how to use it. So this is where you really need to be bringing in more data for your firm. I don't know why it says 2025. I need 2024. So let me. Yeah, so it's you can see with banks, and I've seen this with Costco before as well. It has some of the data, but not all of the data. So your 2025 is not very good. So you actually want to be using 2024, but we should be getting JP Morgan. They've reported earnings, so we should be getting their data here pretty soon. But sometimes it can take a while. Let me see if I can get to the other model. All right, so here's the actual model. There's a tutorial video up front. What you do is you've got the Russell 3000. You sort it around until you get the company you want. You put a 2 by that company. And your key competitors, the top 2 are your key competitors for Walmart. I got Costco and Target. It allows you to look at two competitors. You just sort it around. The video shows you how to do that. And then once you get those names, you copy your twos and your ones over here. Make sure if you have more rows than you need, you'll need to copy everything from everything from column C over to DF and copy it down so it covers all of your firms. So the first part here, this up here is all of the Bloomberg stuff. And you can see Bloomberg, it's all values. That's why you have some empty cells because it doesn't apply. So you got your data, it brings that data in. On the next page, it brings in your company, and then you need to type on D5, the video shows that, whatever you want the graphs to say for your company. Print page 1 is the data for your company. And we'll talk about the different sections that you have, but you have a lot of data here that helps you assess the firm, like revenue growth, earnings growth, cash from operations growth, which for Walmart is not very strong. Gives you your turnover ratios, a lot of really good data there. Print page 2 is your charts, and print page 2 is where you really want to find some stuff to assess your firm. If debt's an issue, show a debt chart, do the titles. If revenue per square foot makes sense, like if I were doing Costco, I would probably use a chart like this to show how strong Costco is. Revenue by employee, you've got a lot of charts to go through. You've got gross margin might be important, asset turnover might be. You got a lot of choices here. You might, in some cases, like a return on equity, say you don't want the bottom 10%, so just take them out. So you can see the rest, so you can edit the charts around. And then I have this other one which does a few of the charts, but just for your two competitors. So it's got the median, Costco, and Target, and then shows Walmart. So some of these charts work. So this works for the materials people. It probably works for energy, probably works for utilities, but it won't work for the financial services ones. So that's why I built a different from banks. I do have, is Joshua in here? Yeah. So Joshua, I do have a file just for P&C insurance. Okay. We need to build one. The two of us might just have to sit down, but I've got a really good chart file just for property and casualty. I built it for my property and casualty insurance class. That does a really good job of bringing in that historical data. It's already set up in Bloomberg. You just got to bring the tickers in. For life insurance, probably gonna have to build it from scratch. You might leave life insurance to the end. I know we kind of talked about that to see how to handle that, but so for all except for financials, this file will work for energy, for utilities. There's probably some extra analysis you want to bring in. You can use Capital IQ to bring those in and build your own charts. But it's set up. It's got your competitors. For a lot of stuff's already set up. You just got to bring in the extra data and work with it. But definitely, y'all need to be bringing in more charts that show your historical trends.
This is on Canvas.
This one I don't think I've put on Canvas yet, but I will. It's the same one from last semester though. So I'll put it out on Canvas again. I was editing it this over the winter break. So yeah, it's just data all over the place. It's a little messy for some companies, but you've really got some pretty decent charts to work with that you can go in and see what's telling your story. Just feel free to take out the lines that don't tell the story. A lot of times all you'll do is just your company versus the industry median. That's all you need. Sometimes the 10% and 90th percentile just make it extreme. I like that because sometimes the company I'm looking at is at the 90th percentile, and I like to be able to show that that's the case. The template for this, we talked about last semester. So I talk about short-term viability in terms of liquidity and solvency. Liquidity, that's all about working capital. And there's some good charts on working capital in the file. How good are they managing receivables? And obviously inventory could be huge, especially for energy companies and materials companies. Solvency is pretty easy to do debt to EBITDA, but if they have a credit rating, you can rely pretty heavily on the credit rating. But some of y'all last semester did talk some about debt to EBITDA that show that there's been an issue. Maybe they did a big acquisition 5 years ago and the debt's coming back in line. Those are good charts to do. You probably won't do a massive number of charts. Remember on liquidity, working capital is closely tied to turnover. So instead of actually doing stuff under liquidity, you might be showing inventory turnover, receivables turnover under turnover. So, short-term liquidity, solvency. Liquidity is all about working capital. Solvency is all about debt levels. Quality of earnings is there something strange going on? There's a chart that looks at that to see if there's some big disconnect between cash from operations and net income. Is something bizarre happening? But generally not an issue we bring up in the pitch book. Where your focus on the pitch book is on turnover, on margins. Turnover, just revenue growth itself, it's really, really good to do. That's pretty straightforward. Some turnover ratio is good. It can be revenue per employee, revenue per PP&E. A lot of times with energy and utilities, they're really specific, like revenue for regulatory assets, revenue for proven reserves, revenue per pipeline miles, something like along those lines is usually something really good to use. You'll have to find your own. We will on Thursday have hopefully everybody from the utility and energy team here. We will have two experts, two alums coming and talking, Andrew and Michael, and we'll have them over here next door. So that group can listen to them. The rest of y'all can work in here on your company. So everybody, utility, energy, y'all can be here Thursday, right? And listen to your experts. So turnover is all about revenue growth and, segments and what different businesses there are. You're talking about who's your customer, all that. Margins, gross margins, net margins, you want to show that over time versus competitors. Pretty straightforward. You may or may not show a gross margin. Kind of depends on your industry. There's no gross margin in financials, so you won't do that. And then something on return on capital. So just put it in your thought process on your pitch book. You've got to have charts interspersed from these different categories to make the case. The best thing to do is tie it to your economic moat. If you're saying they have some economic moat that gives them an advantage, maybe it reflects in their superior margins, maybe it reflects in their higher return on capital. There's something that they're doing that gives them an advantage, and you see it in the numbers. So what you don't want to do is do a pitch book where you have one section on financials. You want the financials to be part of the presentation when you need them to make the point. All right. No one wants to sit in here. Okay, let me talk about their margins. Let me talk about their turnover. No, you want to tie it to your thesis, and you don't have that kind of time to do that. All right. There's some kind of examples after this that may not be all that useful this semester. But that first page shows you the different categories. And what you'll notice is on the Excel file, the charts are in order based on that template. So it starts off with liquidity, then it goes into debt, then it goes into turnover, then it goes on the margin, then it goes on return on capital. So it's in that order throughout. And then you have the same charts again for your competitors. And then for banks, what I did is I brought in a few extra lines like net interest margin. I brought that in. Net interest margin is a key for banks. Efficiency ratios. Efficiency ratios is kind of one of the first things I hear people ask about. So it's pretty straightforward ratio. It's essentially an expense ratio. We're going to see with insurance companies, they have expense ratios as well that you can look at over time. So I don't know if I talked to y'all. I mean, it was obvious at UTSA we had a problem because our expense ratio was so high versus competitors. We were at 30 and our competitors, Geico and Progressive, were at below 20. Our expenses were 50% higher than their expenses. And that's when Bob Davis, laid off 25% of the workforce. Our expenses were just ridiculously high. So efficiency ratios, you can't compete if your expenses are 50% higher than competitors. So efficient ratio is important, net interest margins important, something on the loan loss, you need to look at that. So those are all things you can bring in. You've already got it set up. If you look over here, you've got the capital IQ data. If you see a line that it's not using at all, you can go to that line and go in the capital IQ and try to find something specific to banks. We will have next Thursday, Stephanie's going to come talk about financials. So those on the financial team next Thursday, we'll have you in there with Stephanie. We'll also, the healthcare team, we're going to have a healthcare guy here next Thursday. I don't know, we're going to put all of you people. He might both be over there or something. We'll see. So we'll have two experts next Thursday. Stephanie is she's at Victory Capital and is a former student, was in this class a few years ago. So good. I try to get my best friend. He used to be a banking guy, but he's switched industries. He just didn't want to do it this semester. All right. So if you need help Thursday nights, especially, but I would come by some other time on the financials. If you're just really uncomfortable, set up some time with me and we can sit down and try to figure out what ratios you're going to bring in. How many of y'all are really new to capital IQ? That's just not your thing. All right. So we got to get you comfortable with it, not just because you need it for the class, you need it for life. So, but real quickly, just to show you. So this is the bank still. I don't know why they have inventory, but let's look at prepaid expense. I don't like prepaid expense. So on capital IQ, you can actually do you can do the formula builder. All right, here's working. All right, so formula builder. You go into formula builder, you can type in a keyword on the second line. So let's do provision for loss. And if you type it in, it brings it up. Provision for losses on non-interest bearing. Maybe trading revenue is what you're looking for. It didn't bring that up, so I'm just going to type trading asset securities, trading portfolio liabilities. Maybe it's not trading, maybe it's trade revenue. So you just look for income from trading activities. So if you're looking at the big banks like Citibank, JP Morgan, how much of the revenue is interest? How much of it is fees and how much is it trading? You really want to look at that and look at it over time. So there you have trading. Once you income from trading, once you get it, you add it, you apply, say okay. And just like that, you have your trade revenue coming in. All right, so capital IQ is pretty good. So just find a row. Now that's up here for JP Morgan. All right, so this is on the capital IQ data page. So any line you know you're not using for your firm, you can change it to something else. And then down below, you come over here, starting at line 54. As you go across, like asset turnover means nothing for this bank, for banks. So I'm just going to, instead of using asset turn, I'm going to come over here and bring in, where did I do trading revenue? I don't even know where I put it. Net interest margin, bring in net interest margin. I can copy that across. Well, I already had net interest margin, but so the down below is where you're comparing to your competitors. So if you have something that, sorry. So you have something that you want to use, but so you see it blank down here because it doesn't apply to your industry. You can just update it by changing that. Just realize that it may impact all of your graphs. So be aware. So down here, I'm on the Capital IQ data page. Your company's up here starting in line 1. Any line you want to change, you can use Capital IQ to look for it. And then starting around line 53, going across, it's just the data for your industry. So you can change these different titles and bring in different information that you want to bring in. So you'll have to edit the charts. How do you edit the charts? There's a page called Data for Graph Building. And you can probably figure out how to do that. It's a little complex, but the data for graph building and data by categories, you'll figure it out eventually how it works. It's not that complicated. The data by category essentially takes the data in and organizes it in a way that you can use it. And then the data for graph building just sets it up to build graphs. So between those pages, the Kappa IQ data, the data by categories, and data for graph building, between those, you can get the graphs that you want. But again, if you're having struggles with Kappa IQ, sit down with me and I'll help you build some charts. The nice thing is you're not, like in my previous class, you had to write a paper on this. You're not writing a paper. You're just trying to get 5 or 6 or 7 charts. So it doesn't matter that 20 of your charts look horrible because you're not going to use them. So what we're trying to do is get a few charts that work really well on data you really need. So we can really corrupt this file all you need to. You just need to get the graphs to work. Is everybody see where I'm going? All right, just get the data. So if you're doing a net interest margin chart, then let's go to the charts, page 2, and instead of doing gross margin, I already set up net interest margin. I'll just change the gross margin to a net interest margin chart, and I'll just edit the chart to pick up that data. So you're going to use the template that's there and get the data in that you need. All right. So this file is helpful because it's already set up to pull the data. You will have to do some editing on the chart. Some of y'all won't. So the materials people, it's already set up. It's ready to go. So your healthcare probably will work for most of healthcare here. So probably all but financials, most of this will work pretty well. So financials is the one where we got to do a little bit of editing. Any questions on the financial analysis?
Does it work for health insurance companies?
Yeah. Health insurance, you won't have gross margin. So health insurance have something similar to property and casualty companies where they have loss ratios, expense ratios. Unfortunately, the health insurance companies are on the life insurance side, not on the property casualty side. So you won't use a gross margin, but what we need to find is probably a loss ratio and an expense ratio. If you can find those two things, we'll have to look for them. If you can find those two things. One thing you notice on insurance, like with Joshua at the property and casualty side, the data we need is actually not GAAP data, it's actually statutory data, but Bloomberg does have the statutory data and it's really good data. So GAAP accounting doesn't have loss ratio, doesn't have expense ratios, doesn't have LAE ratios, but the statutory does, and Bloomberg has that data. So Reed will have to look on health insurance and see if they have some of that statutory data, because that's really, really good data. Yeah, it's amazing. Bloomberg doesn't just pull from the GAAP, it pulls from other sources. I don't know how Kappa IQ does on some of these things. I think Bloomberg does have more data than Kappa IQ still. All right, questions on the financial analysis? This is where, if you're not sure, get with me earlier than later, because the financial analysis is actually one of the first things you want to be pulling data in on. If I got to come in on a Saturday to help you, or on a Sunday or whatever, we have to do it here. Unfortunately, we can't do it from some other place. But it'd be more helpful for me if 2 or 3 are working on the same types of companies, that we sit down 2 or 3 and we really work on the model. It might take us an hour, but we can, at the end of the hour, you'll have all the charts you need. All right, so y'all let me know. Don't come to me on February 26th and say, man, I'm really struggling with this, and you got 2 days to get everything done. So this is the week. You should all have your short list. So this is the week to really delve in on this financial analysis. I might put the bank file out there, but just realize I didn't do a lot of manipulation to it. So there's a lot of charts that don't work, but at least on print page 1, I did bring in the efficiency ratio, the net interest margin ratio. Banks do not have turnover, so none of the turnover section for banks and insurance companies just doesn't make sense. They don't have margins. You can see you got a lot of places it just doesn't make sense for banks and insurance companies. All right, so that's the financial analysis. That was, to me, one of the weaknesses from last semester. Not showing your firm's ratios over time versus competitors, I think, is really critical. Some of y'all in your presentations would make a comment, and I could tell from the audience, you'd make a comment in your audience thinking, well, show me a chart that supports that. It's like, man, this firm, their margins have improved a whole lot better than competition. Well, show me a chart that shows that they've come back or whatever. Don't just say it. Put a chart in there. All right. So you've got a lot of reading, a lot of chat GPT. You're going to intersperse that with financial charts, ratio charts. One other thing I forgot to mention, those of y'all, Statista, did y'all use Statista last semester? Was that valuable?
Yeah.
More or less. So Statista is available through the UTSA library. What I like about Statista is you can just type in a company name or type in an industry and everything they have comes up. Now, it may be 1,000 things, so that may be a little irritating, but you can look through and see what kind of analysis they're doing. That will give you some ideas of something you should show for the industry. So Statista is really, really good. I don't know where they get all their data, but it's not a bad way to look for the company. All right. So what does that leave us with? Something else you're going to be doing really, really early on. All right. So this might actually be the first thing you do. So let me show you this. So you got 10 companies. And you got to find 3 of those you're going to do pitches on. What's going to be the most important thing to do your pitch is that the stock is cheap. You're not going to do a pitch on a great stock that's expensive. All right, so we're just looking earlier with Rashid. I love Ecolabs, and so does the market. It's an expensive stock, but I love it. So Rashid might look at Ecolabs and wow, the numbers are all good. It's really profitable. It has a lot of economic moats. But my word, it's one of the most expensive stocks in the entire industry. Yeah. So let's start with the football chart. So pay attention here. Even your last semester, I made some adjustments to it. I'm beginning to love this file. We are in the investment society on Wednesdays. Ben's going to help me with this if you want to show up and help with it. On Wednesday, we're going to run this model on the stocks you gave me last semester, especially the ones that are appreciated the most. And we're going to do a valuation of 2 to 3 stocks a week and just double check. I won't sell a stock based on that, but I'll tell you, our analysis is telling us that Dollar General is getting rich, expensive. We think we should sell it, and you have to tell me if you agree or not. So I will go back to the person, if I can remember who gave me the idea. Boy, I need to put your names by all these stocks. If I can remember who gave me the stock, but we're going to be doing that on Wednesday to help you out. So it gives good training for our investment society, and it gives you the ability to have someone double checking. If you have a stock that you had a range on the stock and it's starting to hit that range, we did sell some of ACMR because Luke was getting nervous. It's up 58% just in a few weeks. So it's rising fast. So we sold half of it and it still kept going up. So that sell didn't help us. But if you have a stock, you should be monitoring the stocks you gave me last semester and watching. If you thought the upper end of the valuation was $80 and we're getting close to $80, you probably should tell me. You're starting to get nervous. But put a sell in on that. Let me show you real quickly our portfolio because I should show it to you almost every class. And this is I'm not making any commentary on these stocks. So if your stock's not doing well, that happens. That's not a slight. So what happens when I sell some or when I buy some, I have to add a separate line, and I don't know why Bloomberg's not working. Let's compare it to, I don't know who to compare it to, but we'll just put Walmart in here. And then what I have here is what industry you want to compare it to. So a good way to figure that out is go into Bloomberg, type your stock, DG, and just do COMP, which is comparison. And they'll actually bring up an industry comparison. So here's consumer staples, but there's other ones out there. This file actually has, if you go to the very end, It actually has sector tickers. You'll see the sector tickers. It gives you some ideas of different industries you can use. So over here, like if you're doing banks, it's S5 banks index. You're doing financials, you're doing healthcare equipment. So I've got some in here, but there's other ones out there. Another way to find one is you can just do S5. You can see they come up. S5, you can type oil and gas, S5 retail composite. So S5 is the Standard Board 500, and then those sub industries, you can find them there under there. Another way you can do it, SPX members, SPS F10 members. And if you do it by sub-industries, you will bring the sub-industries in. Let's see if it will actually give you the titles here. Let's see. It might. Yes, there it is. So see that? That may be pretty helpful too. So those are the sub-industries that you need. So Gerardo, there you have biotech, sub-industry, S5 BIOT. That would be a good one to bring into this model. Where is Gerardo? Over here. So y'all can see pretty good. I just figured this out just tonight. So it's semiconductors is SECO, asset management, those that are doing capital markets, AMGT. So that's what you want to bring in here. I use this for both the relative value analysis and for the beta calculations. So that's why it's good to have that there. There is a drop down here. So you might be able to find one here. This drop down goes to the sector. So if you want to use the drop down, you can, or you can just type over the top of it. There are YouTubes in here and other things to help you with. So when you do evaluation, hopefully you've all done this in your undergraduate. How many of y'all have these for investments? Almost nobody. Reed, you didn't have my investment class? No, I didn't. No one here had my investment class. No, okay, so why do you start with? I'll start with discount rate. For the discount rate, we're obviously using CAPMs. You can just use my risk-free rate, which is the 10-year treasury. That's pretty easy to use. You can use my market risk premium, which is using the implied approach. So what you really need to do here, you come up with your beta. All right, so let's start with that. So you go over to the discount rate. Y'all see that tab there, discount rate? I don't know if y'all can see. Jose, can you see those words or is it too small? And Andrew, can you all read that?
Okay, I can.
All right, so discount rate. So what the discount rate does, let's do Bloomberg. Refresh. I don't know why it's bringing Cap IQ. Well, yeah, no, there is Cap IQ in here. So it brings in the 10-year treasury and the market risk premium, brings that in. You don't have to change those unless you want to. Actually, I think it makes sense for us as a portfolio management firm that we all use the same risk-free and market risk premium. We shouldn't have competing numbers out there. So I like that approach. But if you want to edit it, that's fine. So really what you got to do is come down to beta. So beta has 2 points. One is on line 43, you define your firm. So I'm doing Dollar General. So my base case is 0.5 beta because it's a very low. I'm hoping all of y'all have had beta somewhere. If not, come talk to me and I'll give you a beta discussion. That's my base case. My bull case is going to be my lowest beta, 0.4, my bear, 0.6. It's set up for Walmart. You can ignore that. Operating and financial leverage, I get that from these 2 charts. So what I look at is, I forget how I did this, but wait. I look at how volatile their net margins are. For Dollar General, their net margins are very, very, very stable. And then I look at their debt. So what I said with Dollar General is their margins are very stable. So I'm going to take beta down by 0.1, but their debt is really high. So we're going to take their beta up by 0.1. It's essentially a wash. So very stable margins, but very high debt. So essentially those two are going to wash. So how much fixed costs do they have? How much operating leverage do they have? Very, very, very low as you would expect, but they're carrying a lot. I mean, that's really high debt, 235% debt to equity versus the stock market. And then the history is the next chart. I'm sorry, rolling beta is the next chart. So on the rolling beta, you can change the start date. So for Dollar General, we're going to start them 11/30/2009. Yeah, it didn't do it. So I got to fix this. Sorry. My fault on the beta. Yeah, I thought I fixed it. I'll fix this chart. It was supposed to reference this page and it didn't do that. So I'll fix that. So there's your rolling beta. Here's the industry. I should have had the industry over here, but let me do that. There's the industry. I don't know why it's so high, but that looks like I picked the wrong industry, but we'll look at it anyway. So it brings over Dollar General, which is the green. Walmart is the blue. Costco, and then the industry looks like it's all a retail, not just staples. So, but you can definitely change it. So if I want to change it to just consumers staples, that should fix my rolling beta chart, hopefully. But it bring the industry in, it bring your two competitors in. What you're trying to do is come up with a beta. So on your discount rate, what I did with it is I just brought in the median, the 0.9%, the 0.1%, just so you have a range. And then, so really the key is this bottom line 47. You can type over that. What are you going to use for beta? Those that did the CFA research challenge, did you talk about beta in your paper at all? You actually talked about it? Yeah, you don't, a lot of times you won't see a discussion on beta at all, but you need a beta that you feel comfortable with. So there we got a beta for our stock. So that's the first step. The second one thing you got to do is your growth. Here you go over to the DCF valuation. You have some historical growth rates, 3, 5, 10 years that you can look at. Earnings per share growth, dividends per share growth. You have those numbers all set up for you. You have the PEG ratio approach. You have the ROE approach. This is actually Walmart here, but you can actually go into Bloomberg, do DG equity and type EE. I hope you are taking notes here. EE. When you do EE and change it to annual, you can get a forecast of analysts out there, what they think earnings growth is going to be. You can see that big drop in earnings that you saw in their numbers. But here you can see they were at 592 and analysts are expecting 851, pretty strong growth. You can put that into your Excel as well. So 851. Versus the last year available, which was 592. So you're seeing a lot of expectations of growth in the 8%, 9% range. But you just got to plug in your growth rates here. So long-term growth rates and your short-term, since they're saying 8%, I might plug those in. I don't really know what numbers. You're going to think about the growth rates. So there's a few things to think about here on this page. At the top of this page, you get historical growth rates. If your firm has a PEG ratio, you get the growth rate implied in the PEG ratio. If your firm has a positive ROE, you get a payout ratio growth rate. You can go to the EE function in Walmart and Bloomberg and see what's going on. But then bottom line, you just plug in your growth rates. I shouldn't have plugged them in down here. I should have plugged them in. Sorry. I only type where it's blue. So I should have plugged it up here. So maybe it's 8.5, 9.5, 7, something like this. I don't know this firm well enough. And then, so think through these assumptions. How long do you think this higher growth rate is going to last? And then the other thing you've got to be careful of is your numerator. You have a couple of choices, dividend 0 and free cash flow equity 0. I give you those numbers here on lines 41 through 43. If you're a bank, you'll use dividends. If you're an insurance company, you'll use dividend. There's no such thing as free cash flow for banks and insurance companies, so just use dividends, all right? You'll also notice, and we were talking about why these numbers are so different, and it really has to do with the time period. Some firms, you're off by 1 quarter. So one of these numbers is the prior fiscal year, one of the numbers is the previous 12 months. And you can see some radically different numbers. So if you see big numbers differences there, you might look at it over time and try to figure out what's the best number. So here I'm using 1063. Why? Because we know their last year kind of ended pretty strong, but you can use any one of these numbers. Let's say you don't want to use the 1063, you might multiply by 0 and say instead you're going to use the 418. Or you're going to use the dividend. You'll get radically different answers, right? So think through that. What's the best number to use? Free cash flow for equity is the best number to use unless you're doing banking and insurance, and then you don't use those. Right, so you have very few things to adjust here. There's some discussion you have to have, but you look at the valuation, and then when you do that, it gives you your range of valuations versus the current price. I'm going to go back to free cash flow per share, the second one, and that I've got my DCF analysis. All right, questions on there? The video will walk you through that. The third thing you're going to do is relative value. This one's set up really, really, really well. You go back to the introduction, you see you have relative value model there. So the overview, you can click on it. There's a tutorial that helps you with it. It's already set up and it's already running the data. I don't know why this, oh, I see what my problem is. I need to take the word, and you don't want the word index in this cell for some reason. So it brings in your stock's PE ratio, current EV, the 12 months, price to book, and EV to EBITDA. The one thing I haven't fixed is for banks and insurance companies and maybe energy is on the capital IQ model, allowing you price to book. I need to work on that during this week so we can get price to book set up. So you may not be able to do relative value if you're doing banks and insurance companies yet. I mean, you can't use the cap IQ if you're doing banks and insurance, but I'll get that set up so we can do price to book. Brings that in. You can change the start date to another start date. So if you want to try 12/31/1970, I'm sorry, it's this model here. You want to try 12/31/1970 and just see if it has data. You can certainly do that and see how far back it will go. So a lot of NAs. All right, so it brings your data in. Once you have your data, You got the date. The only thing you really have to worry about is getting the right date. You just take this entire page and copy it, and you paste it to the next one. So now you got your data, and then the next page, the only thing you have to do on the next page is go down to the bottom and just make sure you notice how it stops at 2022. You just need to copy it down so you get it down to the current month. This is in the video as well. It's on a daily basis, so it might need quite a few rows. Oh, word. So copy it down so you have all the data. I'm getting close. All right. So I got data through today. All right, questions, everybody with me? After this, it's all set up. So all you got to do is got to say you want to use EV the sales or whatever price to book. I'm going to use EV the sales. And then I want to do Dollar General versus his industry. And it sets it up. It says historically they've traded at a 14% discount to their industry. Right now they're at a 43% discount. And it shows the range. So it shows that this stock is really cheap right now. This is stock we own, and it looks like it's still pretty cheap. All right, so here's something that is really weak in your presentations last semester. You need to have some type of relative value graph in your presentation. All right, something along like this, maybe comparing them. And you got what you on the relative value output. You have ways to compare you to the industry or to a particular company. Have something that shows where their valuation is today. The other way you can do this is to show your company's kind of current valuation. Or I'm losing everybody. Don't make me scream more now. So if you have questions, whisper really quietly. Better help me because I'm gonna lose my voice. So what some people do is a table to say, hey, they're currently trading at 15 times. Their competitors are 14 times. Historically, they traded at this ratio difference. Something that compares them to key competitors. Relative value needs to be beefed up a lot in your presentations. Bloomberg has a really good relative value comparison. Cap IQ has a really good one as well. So bring some of those into your pitch books. That's a question a lot of people have is, okay, they're trading 43% cheap to their industry right now. Historically, they've only traded 14% cheap. So this stock is really, really cheap to their industry. The cheapest they've been 10% of the time is 61% cheap. So they're actually in their lowest cheapness that they've been. They're in the bottom 10%. So they're still pretty cheap. I'm not seeing a strong argument for selling this stock. All right. The key for this is once you set this up, this is what your Cap IQ model is going to use for your final assumption. All right, so the relative value, what did I do in the relative value model? I made sure I had the starting date where I wanted it, copy and paste it over. When you copy and paste it over, you need to go down to the bottom, make sure it's going through the current date. You just select the entire row and copy it down. Once you have that, the output nothing needs to change on well, same thing on the output. It's the output. You have to make sure you're already down to the bottom. So you run the first page, you copy it to the second page, the third page, make sure you have all of your data in there. Once you do that, the analysis page is set up. You just got to tell it if you want to use EV the sales or price the book or whatever you want to use. All right. So the relative value is very, very simple to use. And then the last thing you're going to do is the investment banking model. This one is fully set up to go, but you need to look at it. So there's a few places you need to type things in. One is the size premium. If you're dealing with a firm below, say, 10, 15, $20 billion, you probably want to add about 1% as a size premium there. Your growth rates, you might want to look at that. So look at starting in line 69, look at some of these assumptions to see if you agree with them. Because Cap IQ is essentially extrapolating the past. What I need to add for banks and insurance companies, maybe energy and material companies, is what I'm going to do to get the price to book is I'm going to bring in their return on equity. I'm going to use that to backward engineer into their book value so that you can do a price to book, but I need to build that still. I think it will be easy to do, but hopefully I can get it done this week. It's already set up to use whatever racer you're using. So here I'm using EV to the cells. So it's already set up to do that. The model just tells it because whatever you use in the relative value analysis, that's what it's going to use. Everything else is set up. The one issue I have had with this model is line H21, the cost of debt sometimes, or I'm sorry, H22, the cost of debt sometimes comes in as NA. If you have that problem, you can get the cost of debt from Bloomberg. You just type your company and type WACC, W-A-C-C, and it will give you a cost of debt that you can plug in there. And even did that to me on Walmart. So really the biggest thing here is to look at the forecast that's starting in L69. Make sure you're comfortable with that forecast. Once I build in the price to book, you'll have it. This model doesn't have book value, so that's the reason we can't use price to book yet, but I'll get it built. The bear case is the same way, except for the bear case. You just got to look at your assumptions and figure out if you like those assumptions. I am pulling some of the assumptions from your DCF analysis. So remember, I typed in 9.5% and 7%, so it's just using those numbers. So the scary part about the investment banking model is it's all set up and ready to run. So you have numbers. But I would still look at it, all right? And it might be perfectly fine without you having to look at it, but I would still look at it, all right? And when you finish all of that, what do you think my football chart's going to look good or not? What do you think? How does that look? Should we sell this stock? Looks pretty decent. Here's our current price. They have come up quite a bit, right? They're on the upper end, but our valuation shows there's a lot more upside to go. So questions on this model? So if you're new to the class, remember on the instructions, there are some videos, I think. No, the videos, I think the videos are actually in the model somewhere. I can't remember if I did a video on the DCF analysis or not, but you have this class video. I know on the relative value model, there is, on the relative value model, there is a video there that you can use to help the relative value model. That works pretty well. I can't remember from Cap IQ, I created a model, a video. I don't think I did. So you can rely on this class. And I can probably find a video from last semester where I walked through it as well, but it's there. This is pretty critical. What you're really after as fast as you can on your companies is try to get these football charts built because you're trying to make sure the firms you're going to do the pitch on look cheap. All right. So it probably take you 20, 25 minutes to do your companies. If you have 10 companies, that's going to take you, 4 or 5 hours to get them all set up. I'd start working on them now and get them built, get those charts set up. And then what's your biggest frustration? You get them all built. And then you go back to the first one and it's up 30% in price. Well, what do? You just load the file and the price will change and you'll see where it is now. You have to kind of reassess your assumptions. But it's pretty straightforward to use. It's not that complex. Questions on this?
What again did you say the first pitch book was due? Or you should have it done.
probably by February 27th. Yeah, it's pretty fast. Let's say you can't get all of the football charts done. You got 10 companies, so pick 4 of them and get this done, and pick one of those 4 to do your first pitch on. If you can't get all 10 done, and then the next round do 3 of them and pick one of those 3. All right, so if you can't get all 10 built, get at least 4 built. If it takes 25, 30 minutes, you can do 4 of them in 2 hours. That's not too bad. You'll have a pretty good idea of what to work. How many of y'all think y'all can use this model? Is some of y'all scared to death? It's like, I don't think I can. The new people are seeing. Chris, Gerardo, y'all think I can handle it, or does it seem too intimidating?
Well,
All right. So if you're really scared to death, what do? Set up time with me, and we'll sit and we'll build it together. So get you comfortable. I've had a few investment society members where we've sat down with the model, I'll let them do all the driving, and they at first were like scared to death, and after about 20 minutes they felt pretty comfortable with it. So it's not that intimidating to use. I like having it all in one model. That may be making it a little bit overwhelming, but it's nice to have everything set up, because there are places in this model where if you do something on the DCF, you want that in another model, and you might as well have them all integrated so you don't have to, like your beta that you're going to use, the Cap IQ model uses that beta. There's no reason to have to rekey it. It just pulls it from the model, so it makes it a lot simpler. All right. So start. I mean, you're doing this other stuff like reading, doing ChatGPT, getting your financials set up, but start working on the valuation pretty quickly. So you start having an idea of which company you want to do your pitch for. So right now you should have your 8 to 10 stocks. Probably by midweek next week, you should have a pretty good idea what your first stock pitch is going to be on, which company. All right. So you got to get down from 10 stocks to 1 that you're going to do for your pitch. Are y'all capable of doing that? Getting your first pitch stock ready by mid next week. That gives you a couple weeks to really research them. You'll have more time in the second pitch. We don't have that March 1st deadline and breathing down on us. So that'll make it a little bit nicer. But this first time, you're a little stressed. Do y'all need me to come in on weekends and other times? Is that critical? And are there times that will work better than others? All right, we'll see. I'm not going to stay for 8 hours, but I don't mind coming in for 2 or 3 hours. I mean, I came in last Saturday and I really didn't want to, but they begged me to come up here, and it's like, oh, I really don't want to come in, but I'll do it. I'll be in clothes for my bike and sweaty and all that, but I don't mind coming in here. So if I got to do some extra time, we can do that. All right. So everybody know what you need to do? Reading, research, get the financial model and get the valuation model, start getting them working, and set up time with the professor if you're scared to do any of these things. All right, we'll stop it there. This is out there on Canvas. I'm going to add, this model is out there on Canvas. I do need to fix a few things still. I keep finding, every time I bring it up, I find something else I've got to fix. I'm going to save this one as DG. This is out there on Canvas. So all I need to do is bring over the all right, let's see if Bloomberg's working here. We'll finish with this. Okay, so since inception through today, our alpha is 31 basis points. I don't know why it changed so much between.
Yes.
Wow, that's pretty wild. I don't know what happened today. Some stock crashed today. I sold Churchill Downs today, so I got to fix that one. We sold Netflix. We sold Abercrombie. ACMR is our biggest contributor, 52 basis points. You're going to see some negatives in there. No stock is real close. Kroger's is getting close. Microsoft, boy, that was, anyone here give us Microsoft? They actually beat on earnings and revenue, and their stock price fell 10%. So that one hurt us. That may be why there's such a big difference between the different dates. Let's see how we did in January. So January by itself, we added 35 basis points. You can see where it came from. 15 of our 26 stocks beat their benchmarks. So we have this. I'm writing the report for January. I'll have that out on Canvas and to UTMCO here pretty soon. So we are beating the market, the S&P. So our return, Bill Gates is really useless. So through January, we're up 933 and the S&P is up 866. January, we're up 189 versus 144, but it does look like February is not going well for us. So we'll have to see what happened in February. I'm scared to run February, but we'll do it. We got a couple of minutes here. Let's just do February by itself. I mean, beating the S&P and adding 35 base points in 1 month is really pretty strong. So that's good. All right, so we'll keep working on this. Do y'all remember which stocks you pitched?
Yes, Ryanair.
Right, yeah, Ryanair is, I remember that's Bobbin. Some of the ones are people who graduated, so they're off the hook. So, all right, I'll stop it there. Any questions on anything, let me know. Don't panic and not tell me that you're panicking. The semester's way too short for you to get behind, all right? So don't get catatonic and you just can't do anything and you're sitting there like frozen. Just if you can't move, you're not moving, and call me and let's sit down and we'll just together. I'll push you through to the next stage.